The truth is, sometimes we get comfortable with the ordinary, sitting inside the lines others have drawn for us, when there is an entire blank canvas of a world waiting for us to trust fall into solutions to questions not even asked yet, to rise, revise, and recognize that remarkable is not only possible, but it is necessary. It is the result of daring to imagine beyond this partition of parameters, always onwards, upwards, and forwards, towards the whys of ideas redefined, the what-ifs of partnerships, the how can we improve this. This is more than a common belief that in order to succeed, we must always see details 3 steps ahead. This is not about spotting market trends or hopping on bandwagons, because many others have been there, and quite frankly, so have we. But we are also about people. Shorooq, the right fit in the right place, like perfectly timed happenings matching skills with partners already found, where the sum of parts can create platforms only teamwork lets you reach. No, not you, us. Plural, collective. A home field advantage, expertise meeting the opportunity of what we did, are doing, and will do. Investing in holding open doors wide enough for impact to walk through. So we continue being the outlier, the deviation, the above and beyond expectation, the ones uncomfortable with being ordinary. Today is the day. Join Shorooq Partners.
Welcome everyone to our weekly MENAP Venture Debt Series, where every Tuesday at 3 p.m. GST, Shorooq Partners and IMM Investment Global go live on LinkedIn, Twitter, and YouTube, where we collectively talk about venture debt and answer all your questions that you might have. If you're watching this through our LinkedIn, Twitter, or YouTube, remember to follow, subscribe, and click that icon or bell icon so that you get notified of all our news, events, and updates. This show is brought to you by Shorooq Partners, the leading tech investor in the Middle East, North Africa, and Pakistan. And I'm your host, Tariq Fouad, Head of Growth at Shorooq Partners, and I want to thank you all for tuning in from wherever you are. I would like to introduce all our colleagues here. So Sean Jin, Director at IMM Investment Global, and then obviously our very own Nathan Kwan, Senior Investment Professional at Shorooq Partners. Thank you, both of you, for joining us this week.
Thanks for having us, Tariq.
Thank you. So, thank you so much. Following on previous week's discussions, this week, I think we're reserving it to understand the underlying mechanics of venture debt. And I would like to open up the question to probably you, Nathan, and kind of just making sure that everybody who tuned in for the past few weeks also get a reiteration of that very important question. What are the components of venture debt?
Thank you, Tariq. So I think this is a great place for us to start today's discussion on the topic of the mechanics of venture debt. So in order for us to talk about how venture debt works, we first need to talk about what is there, what are the pieces that make up venture debt. So really, in broad strokes, there are 3 different components to a venture debt investment. There is, of course, as the name implies, the debt portion of it, which consists of a loan that we give out to a company, and then there's a specific yield that is attached to it. Now, on below that debt that is underlying it is a security package that we take for each investment. And the purpose of that security package is to help us secure the loans, and also by providing that additional stability to this investment, it helps the company manage the cash flow and also to unlock better rates in receiving that loan. Now, sitting on next to that portion of it are the warrants. So any venture debt investment, we usually take a small portion of our warrants go along with the credit part of the loan, the investment. And the reason we do that is we don't want to be in a situation where we are only a credit holder. And what I mean by that is if you're a traditional bank, then your main purpose is to do whatever is best for you as a credit holder and foreclose on the loan should there be missed payments or maybe the company runs into trouble. Then it is in the interest of the bank as a traditional lender to just take the security and close everything. Now, by taking a bit of a warrant investment with us, we're invested in the company's growth from the equity side of it. So in case where there might be a little bit of a trouble, the company just needs a couple more weeks to make a payment, then we are in a position where we can also be flexible to work with the company to make sure that we are helping the company create value rather than trying to foreclose as soon as possible. So that warrant piece is what helps us is align the incentives together with the credit holders and the company.
Got it. Thank you so much, Nathan. There, and I think it's a good summary of what makes up or what's very common in terms of what makes that venture debt what it is. And I think over to you, probably, Sean, if you can, the warrant piece is a very common piece in all venture debt instruments. From your experience, if you can maybe explain to us a little bit more of what warrants are, how do they work, why are they important for investors, and what does it mean from a founder perspective?
Sure. So yeah, I mean, some of you might not be familiar with the instrument warrant, but to make it easier for you guys to understand, it's essentially an option, just like the way stock option works for employees. But it's an option given to future investors to acquire shares at a fixed valuation. So it's much like the stock option, but given to investors. There's a specific valuation that is prefixed. So you expect the exercise price to be at the valuation, and typically the warrant has the exercisable period. So it can be as long as the negotiated period, typically 2 to 3 years, or sometimes if the company wants to offer more favorable terms, the period tends to be longer. But essentially, what it does is it captures the kind of compensation for the risk that the lender is taking on, because at the end of the day, venture debt is given out to venture companies that do not have proven cash flow models. So the risk profile is definitely higher than the traditional credit targets.
Okay, got it. And from your experience, Sean, and you talked about risk here, warrants are there to basically give back or pay back for the risk the investor took. But from the components perspective, we also understand that there is underlying securities that have come with the venture debt round. What are some of these types of securities that founders should know of, and what types of them from your experience?
Sure. Because it is debt, you obviously need collateral, and because we're facing venture companies that are still in the scale-up process. We still have to take a little bit more aggressive stance as to assessing the value of these collaterals. So we'll typically try to look at some assets such as inventory or AR, or even some assets that the company wants to purchase as part of their capital expenditure, or even account pledges. So the future cash flow can be something that the fund can collateralize. So on top of that, we will typically ask for share pledges because at the end of the day, liquidation of such assets cannot fully repay the principal. So if there's a residual amount, we'll try to cover with the sale of these share pledges.
Got it. Nathan, as Shorooq Partners have obviously done a few investments there on the venture debt side, what were some of the examples that you would like to share with all the other founders that are out there that you've seen at least experience from Shorooq perspective, but also from your previous career when it comes to collaterals?
Sure. And Tariq, that's a great question because I think this is where, as investors, we get to kind of have some fun with and get creative with. So really, the essence of the security is, as Sean explained it, it is something that we take in order to underlie the credit investment that we make. But what form it can take and what sort of a structure that can be applied can be very varied. And there are different ways of doing it. There are different types of assets. As Sean mentioned, there could be inventory. It could be the receivables in a company. It could be physical, tangible assets such as PP&E, if such assets do exist. And because we're talking about startups in a relatively early stage compared to these larger blue chip companies at the PE, there needs to be some amount of creativity involved. And this is where we work with the founders to kind of make that happen. What asset would be the best for you guys to provide to us? What would allow you to get a better rate? What would allow you to unlock that value that has been lying dormant in your company? Because if it's an asset that's just sitting on your balance sheet, it's not really doing much for you. So we want you to help think about creative and effective ways to utilize that in order to provide, in order to create that additional cash flow, which comes in the form of the debt investment we have. So to maybe give, I think, two interesting examples. One could be that for companies such as that are in the ag tech space, then that means you have a large space of either a farm, equipment that are go with growing the crops, or even the seeds that are lying under your warehouses. So those are tangible physical assets that we could take. And it is also a great kind of a collateral in the security because it is physical, it is tangible, it is there, and it's easy to do. Now, of course, most startups don't have such physical assets. In that case, another very common way to do it is to take on the receivables that a company has from their clients, from customers. So although these are not physical assets per se, because they do guarantee a specific amount of payment, and there's a relatively stable, how should I say it, projection that could be attached to it in terms of when it could be taken back. It is another great form of asset and is a much more commonly available form that I think founders will have on their balance sheet.
Got it. Love that. Thank you so much, Nathan and Sean. Maybe it's a great segue for us to kind of remind everybody who is tuning in today to ask any questions you might have on venture debt or to IMM Investment Global or to Shorooq Partners, right? We have representatives from both companies, and we are happy to answer any of your questions. We really want to thank Pawan, who's joining us from India. Thank you, Pawan, for tuning in and for typing in your comments. I really appreciate you tuning in today. And remember to put your questions in the comment section. As we come closer to the end of today's session, we can always tap into some of these questions and answer them. So back to probably you, Sean. I wanted to ask, typically with it being a debt, obviously there is expected certain interest rates and payment schedules. From your experience, what is the range of interest rate and the rate, the length of these payment schedules that a founder can expect?
Right. So a lot of startups clearly have are facing a situation where they're burning a lot of cash. They although they are growing really quickly, the capital raised in each round tends to be quite large, and the valuation uplift in every round tends to be exponential. So, they clearly realize the cost of capital through raising equity is extremely high. So,
Yeah.
I mean, if you think about it, if your company is doubling in the period of 2-3 years, your IRR tends to be way above 30%. So, they're willing to provide us with relatively attractive interest rates, which tend to be around 12 to 15%. And in some cases, if the company has clear kind of visibility over their growth, they want to take more aggressive kind of approach in terms of the interest rates. But that's the roughly the range that we're seeing.
And when it comes to payment schedules, how long usually a debt is being paid for, and for how long?
Sure. The tenor typically tends to be between 2 to 3 years. We try to keep it not too long, because there's definitely a risk involved in the length of the tenor, and also given that the company will have different kind of schedules in terms of raising the next round. And if you're looking at a fast growing startup, you tend to see at least one round of fundraising over 2 years. So that's the roughly the kind of guided timeline that we work around.
Understandable. Yeah, you
Here,
yeah, go
sorry,
ahead.
if I kind of add in here.
No, please do.
I think my colleague Sean hit the nail on the head here. And something I wanted to zone in a little more here is that myth that because there is a fixed coupon payment, that it could actually add to the cost of the capital to your company. So if you really think about it, equity, because right now it may seem like you're not giving up anything. There are no payments that you have to make on a regular basis. But if you are a company that is growing quickly and that you're doing well, that equity that you put up to raise the fund, to raise the capital now, could in a couple of years accumulate to a cost of millions of dollars, right? If you're a company that is going from, let's say, a 20 million Series A to maybe 100 million Series B, and then hopefully 200, 300 million Series C and above, then that 5%, 7% capital that is put up there quickly rises.
Yeah.
And that is what our my colleague Sean was talking about in terms of the IR accumulating. So it is, of course, there are benefits to equity that despite having that, despite having that kind of accumulated cost down the road, there are benefits that come with it, and founders should definitely utilize it. But if you want to be smart about it, there is a substantial benefit to creating a balance between debt and equity on your fundraising needs. And I think it's a great point for you guys to consider as you guys think more about what is the best path forward for the companies.
I love that. That probably requires us to do another live just to kind of cover some of the examples of where in the life cycle of a startup would potentially venture debt play around. And probably just like the timing of an equity round is important, probably it is the same for venture debt. And kind of speak a bit more about timing. And that's a great segue, Nathan, to one of our last questions for today's live is, how, as a founder, should I make my company ready to receive venture debt? What do I need to do internally to make myself attractive for investors in the venture debt space?
It's a great question, Tarek. And let me break that down into two aspects. So one is on a very specific and technical level. What are the kind of the data room and the materials that you would have to prepare if you have a venture debt round inside? And the second part would be a kind of a more abstract, a high-level view of how can a company in its growth stage become ready to be in a state where they might be able to knock on the doors of a debt investment. So on the first part, in terms of like specifically which materials would be required, of course, you start with a data room like any other that you would have for a typical equity round, right? We also look into the company's finances, your business, the kind of the technology stack that you have, what are your corporate structure, what is your employee count. So all of these typical business and commercial questions that come up during an equity round, we would ask as well, and we would request for visibility. Now, something that might be a little different here is that we look much more specifically into the other kind of obligations you have. So has the company taken out any debt? Are there any kind of credit obligations on the company that you might not kind of consider to be a loan because it is in the natural course of business? But if it's a trade credit, if it's a lien or a mortgage that you have provided to one of your vendors maybe, or one of your corporate service providers in order to get premium rates. So those are all obligations that we look for. On the in addition to that, another thing is we want to make sure that the company is in a very sound place legally and from a regulatory perspective. So from in a very early stage equity, because all the focus is on growth, sometimes it might be a little difficult to implement all the right, let's say, governance structures or the cash flow controls or these sort of things that help company become more stable, and it will boost the company's growth down the road. But it might be too much of an inconvenience right at the beginning to take care of everything. So those are some of the more of these, triggers that we would also kind of help you guys walk through and then think about more as you start raising venture debt. Now, on the more of an abstract level of what can a company do in general to get ready for debt is, I'd say there are two things to it. One is, of course, because debt requires a regular payment, it helps when you have a track record to show of meeting such obligations. That could be maybe payments to your corporate service providers, to your vendors. It could also be just that you have now reached a point where there's a recurring stream of revenue, that the cash flow projections you have are now much more based on a concrete, either a track record or maybe a sales contract that has a couple of years of duration down the road. So these kind of basis on which stable projections could be built, on which you could prove to us that, look, we are responsible, we're a fiscally responsible company, and we have reached that maturity is always a plus.
I love it. Thank you so much, Nathan. Sean, anything there to add prior to going to the questions?
Sure. I think I've mentioned this in our earlier session, but in principle, it's at the end of the day, it's an instrument of debt instead of equity. So it's important that you have a validated business model. So I think the first requirement will be a stamp coming from an institution, preferably, to show that your business plan is not just based on the plan, but actual track record and something that can be validated through a group of playbooks and financials that show that you have clear payback period and the mechanisms behind your business. So I think that's like the very important kind of difference between equity kind of investment targets and our venture debt targets. So I think it's important to focus on the soundness of the business modules and initiatives that you have, and make sure that you can apply the same kind of playbook but in a larger scale, so that your growth can sort of take shape of a sustainable kind of growth, and that can play into that can be translated into your premium in the next round of fundraising. Because at the end of the day, we want to see our targets to get their next funding with much higher valuation, with more reputable investors.
Understood. This very, 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 very good closure and segue, Sean, to the question Ryan is asking. So thank you so much, Ryan, for asking. So building on the current question and what we've said about targets and what to expect when it comes to interest rates. What are the terms usually that anybody can expect when it comes to warrants being requested? Sean, would you like to take that?
Sure. I mean, it really depends on case by case, because founders tend to have different kind of requirements and preferences as to their own risk profile and their own return profile. And sometimes we see different cases. So there, it's really hard to say what's like the typical kind of playbook. But I'll tell you about the minimum requirement, because we certainly have to work towards our target IRR of the fund. So I think the warrant should at least be above 15-20% of the loan size. There are some cases where it's difficult to secure that amount, but we will try to sort of compensate for other kind of incentives. But that's like the bare minimum that we'll try to work for, and our preference is to have more exposure with warrants, so that in the end we're not just a typical kind of lender that is only looking for financial return here. So our involvement and all the ask and kind of communication is geared towards helping the company to do better and make sure that they achieve the kind of growth trajectory. So I think the equity alignment is something that will help us secure more resources from our end to help the company.
Love that.
Nathan? And on this, if I could add a little more color. So there are two ways that we would think about this warrant pieces, the warrant piece. One is that it has to be substantial enough that if push comes to a shove, that we don't just disregard it, right? And this goes back to the point I was making earlier about how the warrant helps the lenders and the borrowers become aligned. So if it's too small, then if push comes to a shove, we could just be disregarding that, and that's not a situation we want ourselves or the founders to found themselves in. So that's the first piece. The second piece, of course, as investors, we do have our fiduciary duty. So we want to be looking for a minimal amount of a return that the warrants could generate for us. But this is where it gets, I think, fluid, like the way my colleague Sean put it, because the returns piece is a combination of the debt yield and the warrant yield, right? So if you guys, if a company could offer maybe slightly larger amount of a warrant, that means the debt yield, we could lower the debt yield and vice versa. And the other kind of a component that is also, not to make the equation even more complicated, but such is the business of investing, is that because of the warrant pieces, it depends not only on how much percent we get on the loan size, but also the strike price at which the warrant is offered, right? So if we start with that 15 to 20% range that Sean has cited for you guys, and then if the strike price maybe goes up, that amount could be increased. If the strike price goes down and makes the price more attractive for us, we could also have a much smaller piece of the warrants. So it is a fluid mechanic. There isn't a clear-cut answer, but I know you guys are looking for some more specific numbers to match to, and I think Sean has provided that benchmark range to begin with.
Love that. Thank you both. I mean, it's not an easy question to answer right away, and I really want to thank Ryan for asking such a question. Unfortunately, we've come to an end to today's live. I really want to thank you, Nathan and Sean, for kind of joining us on a weekly basis to bring light to one of the very important financial instruments that are playing in today's ecosystem, and one that is very important for all the tech startups that are growing out there. Our role is to really shed light in making sure that the playing field is understood by everyone, and that the founders have access to the knowledge and the know-how and what to expect from venture debt, so then they can play it smart, and we can also be humble and proud to be part of the journeys of a lot of the great founders that are out there. So thank you again both for joining us today. I'm looking forward to next week, where we'll discuss venture debt even a lot more deeper. For all those who are joining us from wherever you are, remember, send us your questions, right? Write down in the comment section, or reach out directly to Nathan or Sean on LinkedIn, or remember to follow us and DM us there, or at least visit shorooq.com today, and you can send us an email with your deals or with your startups. And if you're looking to partner up with us, you can always reach us at Shorooq Partners. That is at Shorooq Partners. You can also know all about IMM Investment Global through visiting imm.co.kr today. From myself, Nathan, and Sean, thank you so much all for tuning in. Have a great day.